everyone. Hi guys. Hello everyone. Good evening. How are you all? Good evening everyone. Am I audible to everyone? Am I visible to everyone? Audio, video, everything is good, working fine. Yes or no? Hi guys. Hello. Good evening. Am I audible to everyone? Am I visible to everyone? Audio and video. Everything is good. Everything is working fine. Yes or no? Kindly just please comment once about the audio and video of the class. Everyone. Hi guys. Hello, good evening. I hope that I am audible to everyone. Okay. Good evening, Kamal. Good evening, everyone. Good evening. So, today we have to discuss the complete IEFS numericals. Everyone, the complete numericals we have to discuss. So, in this class, I'm going to take all the numericals, all the topics from where the numericals can be framed in your examination. Okay. So, today is a very, very important class for all of you, everyone. So let's start discussing with the very first question of the class. The very first question, easy question, nothing complicated, but just understand the question. Okay. In India, if India's total insurance premium, life plus non-life in a particular year is 7.2 lakh crore and the country's GDP for that year is 240 lakh crore, what will be the insurance penetration rate? Also, if the next year the premium increases by 20% and the GDP grows by 10%, then what will be the new insurance penetration rate? So we have to answer this question. Everyone just start answering this question. Everyone, so the correct answer for this question is what? Please answer, everyone. The correct answer for this question is what? If India's total insurance premium, life plus non-life in a particular year is 7.2 lakh crore and the country's GDP is 240 lakh crore, what will be the insurance penetration rate? So first of all, just tell me the formula of insurance penetration, everyone. Okay, and then try to solve the answer. It's very easy, it's very simple, nothing complicated. You have to understand and answer this question, everyone. Please answer. So the correct answer is what? Calculate and answer, everyone. Okay, I'm waiting, guys. Okay, so first of all, let's talk about the formula. And the formula says that insurance premium, insurance, we have to calculate the penetration here. So if we talk about the insurance penetration, right? So the insurance penetration is what? The formula is premium to GDP, insurance premium to GDP, and if we have to convert it into rate, so into 100, right? So in the first year, now let's see, in the first year, the insurance premium is 7.2 lakh. Okay, so 7.2, okay, divided by GDP for that year is 240 lakh crore into 100. So if we talk about this, 7.2 divided by 240 into 100, that is 3%, right? So for the first year, it is 3%. Okay. Now let's talk about the next year. So next year, first of all, see there are changes. Changes is 20% increase in the premium. So 7.2 plus 20% of 7.2. It's very simple thing, right? So it is what? It is approximately 8.64. Then there is 10% increase in the GDP. So 240 plus 24, that is approximately what? It is 64. So now if we calculate the insurance penetration for this year, it is 8.64 divided by 264 into 100. So the correct is 3.7%, right? So if we talk about the penetration for the previous year, it is 3%, and for the next year, it is 3.27%. So the correct answer here is what? C is the correct answer. Yes, Tanya, C is the correct answer, and everyone else. C is the correct answer. Okay, done, clear? Yes, any doubt in this question? This is a very easy question, very simple question just for starting. If you have any doubt, kindly please ask. And if no doubt, just please comment once. Just please comment once. Everyone, if you have any doubt, ask. If you don't have any doubt, just please comment once. Everyone. Prabhu, okay, no doubt. Tanya, Kamal, and everyone. There are a lot of bankers currently watching this session. Just give me a thumbs up, everyone. Okay, I hope that everything is clear. Okay, now next question is what? We have given the data for the country in crores. Now, this is the data which is given in crores. The private final consumption expenditure C is 6,200 crore. Then government final consumption expenditure G, that is 2,500 crore. GDCF means gross domestic capital formation, means investment, that is 2,000 crore. Export, it is 13,000 crore. Import, it is 18,000 crore. Net indirect taxes, it is 400. Changes in the inventories 300, which is included in investment. Now you have to calculate the GDP at market price. Everyone, now you have to calculate the GDP at market price. First of all, just tell me the formula of gross domestic product at market price, and then you have to calculate. So it's very simple, it's very easy, nothing complicated in this. Everyone, please answer. So the correct answer is what? Everyone, kindly please answer this question. It's so simple question. You can easily answer this question. It's very simple. It's very easy. You can all answer this question. Prabhu, just understand the question carefully and then answer. GDP at market price. We have to calculate the gross domestic product at market price. So the formula, once I have written the formula, you can just easily calculate it. GDP at market price is equals to C plus I plus G plus X minus M, right? Simple thing. Now, you think this is the changes in inventories. It is already included in the investment. So you don't need to add it exclusively, okay? Because it is already included in the investment. So we don't have to do anything with the changes in inventories here. Now, consumption is 6,200 plus investment is 2,000 plus if we talk about the G, government final consumption expenditure, it is 2,500 plus export minus import. So export is 1,300 minus import is 1,800. Very simple. Okay. So 6,200 plus 4,500 plus it is minus 500, right? So 6,200 plus minus. Okay. So it is plus 4,000. So the answer is 10,200. The correct answer is B, 10,200 crores. Yes, B is the correct answer. That is 10,200 crore. Any doubt in this question, everyone? Kindly just please like and share the video to the maximum you can. Whoever is watching in the YouTube, kindly just please like and share the video. Everyone. Any doubt in this question if you have? Tanya, Kamal, Prabhu, and whoever are watching this session. Clear? Everyone. Clear? Which? This is which chapter? This is national income. The insurance penetration and insurance density, that is the module C insurance topic. Okay, that is module C insurance topic, insurance penetration and insurance density, if you remember. Okay, done. Can we move to the next question? Very good. Okay, let's talk about the next question. XYZ is making a compulsory book build issue with a net offer size of rupees 800 crore. Based on SEBI's regulation, calculate the maximum amount that can be allocated to non-institutional investor NIIs and retail individual investor RIIs. So the correct answer is, everyone, please answer this question. Please answer this question. It is net indirect taxes. So net indirect taxes, you don't have to do anything because we have to calculate the GDP at market price, right? We have to calculate the GDP at market price. If you want to calculate GDP at a factor cost, then you have to take into account the net indirect taxes. Some things are given just to what? Some things are given just to complicate the situations, right, Gopal? So net indirect taxes, if you all remember the national income, the topic which I have explained, we have to calculate GDP at market price. We don't have to calculate the GDP at factor cost. So the formula is straight away what I have written. There is no use of net indirect taxes when I was intentionally adding some informations just to confuse you all. Okay. Now tell me the correct answer here. Everyone, please answer. This is easy. Please answer this question. Now, here you have to use the concept, everyone. Here you have to use the concept. Now, if we talk about NIIs and if we talk about the RRIs, so the maximum percentage which can be allocated to the non-institutional investors, if you all remember, it is 15% of the net offer size, and the maximum percentage that can be allocated to the retail individual investor in the compulsory book building issue is 10%. This is the maximum percentage, everyone. So in a compulsory book building issue, always there are three proportions. See, for the qualified institutional buyer, QIBs, at least 75% of the net offer you have to allocate, at least 75%. And if you haven't allocated at least 75%, then you have to refund the complete net offering. Then you have to just return the complete net offering in the compulsory book building issue. This is for the qualified institutional buyer. And then for the non-institutional buyer, maximum of 15% of the net offer size you can just allocate to them. And for the retail individual investor, maximum of 10% you can allocate to them. Right? Now here, question is just asking about NIIs and RRIs. The percentage I have written, now you just have to answer, everyone. Now you just have to answer. So the correct answer is what? Obviously, Kapil and Ravi. So the correct answer is A. Net institutional, sorry, non-institutional investor, 15% of 800 crore. It is 120, right? And for the retail individual investor, it is 10% of that. That is 80. Okay, so the correct answer is A. Any doubt here? If you have any doubt, please ask, everyone. Any doubt? Just quickly give me a thumbs up. If you have doubt, ask your doubt. If you don't have any doubt, just please quickly give me the thumbs up. Every one of you guys. Clear? Okay, next question. Now see this question. Okay, I'm just switching off the microphone for just 1 or 2 minutes. Let the azan complete and then we will discuss this question. Okay? Okay, everyone. Okay, now tell me the correct answer of this. This is so easy question. The market for the smartphone is presented by the following demand and supply schedule. Okay, so we have the prices listed here. 2000, 3000, 4000, 5000, 6000. These are the prices. Now the quantity demanded is written here. This is 100, 80, 60, 40, 20. Then quantity supplied is written here 20, 40, 60, 80, 100. Now you can see the law of demand and law of supply. There is an inverse relationship between price and quantity demanded. That is law of demand. As the price increase, the quantity demand decrease, whereas there is a positive relationship between price and quantity supplied. Why? Because law of supply says that as the price increase, quantity supplied will also increase and vice versa. So this table is representing both law of demand and both law of supply. Now we have to choose what is the equilibrium price and quantity in this market. Equilibrium price and quantity for this market, everyone. So equilibrium price and equilibrium quantity for this price. Everyone kindly please answer this question. So the correct answer is what, everyone? You can all answer this question. This is so easy question. You can all answer this question. So the correct answer is what? So if we talk about the correct answer, equilibrium position is when law of demand is equals to law of supply. Or you can say when demand is equals to supply. Okay. Or you can say when buyer is satisfied with the seller, then it is called as what? Then it is called as the equilibrium. Clear, everyone? So when we are talking about the prices, it is 4000 where the quantity demand is equal to quantity supplied. So obviously the equilibrium price is what? 4000. 4000 is the equilibrium price and the quantity, okay, at which we have achieved the equilibrium price is 60 unit. So we don't need to calculate anything. We just need to understand the concept and the question is clear. So A is the correct answer. Okay, done. Done, everyone. Good. Next question. Now, in a certain economy, the following are the components which are reported. So, currency with the public is given 500 million. Demand deposit with the banking system 300 million. Other deposits with RBI 100. Savings deposit of post office saving banks 200 million. Giving the definition of narrow money M1 and M2. What is the total amount of narrow money M1 in this economy? If the government issues 50 million in new currency, what will be the new amount of M2, assuming that the other components remain unchanged? Now you have to answer this question. It's so simple. Just you have to understand the question and then you have to answer. It's very simple. It's very easy. So the correct answer is what? Everyone, please answer this question. So the correct answer is what, everyone? Please answer. It's very simple. It's very easy. You can all answer this question, everyone. Start answering the question, everyone. Kindly please answer this question. Okay, so Tanya is saying A. Ravi is saying A. This is for this question or previous question. The correct answer is what, everyone? So when we are talking about, first of all, the narrow money, okay? So narrow money, the formula of the narrow money is what? So M1 is equals to currency with the public 500 plus demand deposit with the banking system 300 plus other deposit with the RBI is 100, right? So if we talk about this, it is 900. And M2 with the normal conditions, the M2 is what? 900 plus means M1 plus saving deposit, which is 200, which is 1100. This is under the normal circumstances, right? So first of all, what is the total amount of money M1 in this economy? In this economy, we are asking the M1. So M1 is 900. Okay. Now, if the government issues 50 million in the new currency, 50 million in the new currency means now the currency with the public is 550, right? So what is the new M2? So M2 is very simple. We just have to add. First of all, calculate M1. It is 550 plus what? Plus 300 plus 100. And finally, you have to add 200 also. So M2 is what? See, it is 1150. So it is 900 M1 and M2 is 1150. So the correct answer is A. A is the correct answer. Not D. A is the correct answer. Clear? Done, everyone. Any doubt in this question? If you have, kindly ask. Any doubt? Kamal, Tanya, Ravi, Prabhu, Gopal, Gursimran, any doubt? Just quickly give me a thumbs up. If you have doubt, ask. If you don't have any doubt, just quickly give me a thumbs up. Right? Good. Very good, guys. Good, everyone. Good. Clear. Good. Next question. Now, ABC Limited is launching a compulsory book build issue. Okay. Now understand again, a compulsory book building issue question is there. The total net offer is 1000 crore. At close of the bidding, the qualified institutional buyer subscribed to 700 crore worth of shares. The non-institutional investors subscribe to 150 crore worth of share and the retail individual investors subscribe to 100 crore of the shares. Now, based on the SEBI's rule for the book build issue, what will happen next? The issue can proceed because the total subscription exceed 1000 crore. The issue must be refunded because the minimum 75% of the QIP subscription criteria is not met. The shares meant for KIP can be reallocated to RIIs and NIIs. Only the unsubscribed QIB portion will be refunded. The rest of the issue can proceed. We have to answer this. It's a very simple question, and we have discussed this question, a part of this question earlier also. Everyone, now please answer this question. It's so simple. Tanya, B. Yes. The correct answer is B. See, for a compulsory book building issue, I have told you three things. First of all, at least 75% should be allocated to the qualified institutional buyer, and if it is not allocated, then the whole subscription must be refunded. Second, for NIIs, you cannot allocate more than 15%. For RRIs, you cannot allocate more than 10%. So if we are talking about NII and RII, both the criteria are met because 150 crore and 100 crore, these are not more than the limit. But the first point, for the qualified institutional buyer, at least 75% should be given. So at least 75% of 1000 crore is 750 crore, right? Which is qualified institutional buyer is allocated less than 750 crore, that is 700 crore. So this is not valid, and so you have to refund the entire issue because 75% of the qualified institutional subscription is not met. So if we talk about the correct answer, yes, B is the correct answer. Now, if you have any doubt here, you can ask your doubt, everyone. Any doubt in this question? Tanya, Gopal, Prabhu, Ravi. Everyone, any doubt in this question? If you have, please ask your doubt. If you don't have any doubt, give me a thumbs up. Everyone, done? Everyone, give me a thumbs up. If you have doubt, ask. If you don't have any doubt, give me a thumbs up. Each and every one of you. Right? Clear, everyone? Done? Good. Now, next question. In an economy, now again, it is related to narrow money and broad money. Narrow and broad money. So in an economy, the following components are reported. Currency with the public is 750 million, demand deposit with the banking system 500 million, other deposit 300, time deposit is 600 million. To calculate the M1 in this economy, then if the government increases the currency by 100 million, you have to calculate the M3 in the new economy. So we have to check the correct answer. It's so simple, it's so easy. You can all answer this question, everyone. You can all answer this question. So the correct answer is what? Everyone, please answer this question. The correct answer is what? Tanya, Gopal, Prabhu, Ravi, Kamal, and everyone, please answer this question. Kamal is saying A, and everyone else. Kamal is saying A, and everyone else. Right. So if we talk about, it's very simple. You just have to understand the formula. M1 is simple. 750 plus 500 plus 300. Okay, so if we talk about this, it is 1550. Okay, now if the government has issued 100 million more in the currency, so now the currency with the public is 750 plus 100 means 850, right? And now we have to calculate M3. So M3 is adding all of these 850 plus 500 plus 300 and plus 600. Obviously it is 2250. So this is with the old, and this is when the government has issued the new currency 2250. So the correct answer is A. Good, everyone. The correct answer is A. Any doubt in this question? If you have, please ask. If you don't have any doubt, give me a thumbs up. Everyone. Any doubt? No doubt. Good. Now, next question. Now, just understand this question very carefully. Don't rush and then answer. Okay? Just understand the question carefully. A 10-year bond with a face value of rupees 1000 and an annual coupon rate of 8% is currently priced at par in the market. Okay? That is, its current market interest rate is also 8%. Now consider the two interest rate change. The interest rate increases from 8% to 9%. Now, in the scenario B, the interest rate decreases from 8% to 7%. Assume annual coupon payments and no taxes or transaction cost. What can be said about the changes in the bond price under both the scenario? The price of bond A will decrease more in scenario A, then it will increase in B. The price of bond will increase more in B, then it will decrease in A. The price change in both scenario will be exactly equal. The price will remain unchanged if both scenarios as the interest rate change is the same 1%. So the correct answer is what? Understand, remember the bond theorems and then answer. Remember the bond theorems and then you have to answer. Please answer this question. Carefully answer this question. Everyone, carefully answer this question. Everyone, please answer this question. Okay, so now the answer is coming A. Okay, Prabhu is also saying A, Harsh is also saying A, everyone else. So here again we have to use two bond theorem. First of all, we know that The theorem 1 says what? The theorem 1, bond theorem 1 says that there is an inverse relationship between bond price and the interest rate. As the market interest rate increases, bond price will decrease and vice versa. Now, theorem second, if you all remember the theorem second, the increase in the price of a bond when interest rate goes down by a certain percentage is greater than the decrease in the price when the interest rate goes up by the same percentage. Now, understand this particular theorem. It is saying that always the increase in the bond price will greater than the decrease in the bond price if the market interest rate is changing by the same percentage, right? So here you are saying that it is increasing by 1% here and it is decreasing by 1% here. Okay, so in the scenario one, when the market interest rate increases, obviously the bond price will decrease. Okay, and in the scenario two, when the market interest rate is decreasing, obviously the bond price will increase. And the changes is exactly same 1%. So when there is a same percentage change in the market interest rate, which is here, always remember the increase in the bond price is always greater than the decrease in the bond price. So increase will always greater than. So means in the scenario B, when the bond price is increasing, it is always greater than the scenario A when the bond price is decreasing. So the correct answer is the price of the bond will increase more in scenario B, then it will decrease in scenario A. So B is the correct answer, not A. B is the correct answer, not A. Now tell me if you have any doubt in this question. Anyone, any doubt in this question, you can ask your doubt. If you don't have any doubt, give me a thumbs up. Tricky question, but important. Everyone, Harsh, Prabhu, Tanya, Gopal, Ravi, Kamal, everyone. If you have any doubt, kindly ask. If you don't have any doubt, give me a thumbs up, each and every one of you. Otherwise, same percentage means A only answer. Same percentage? Yes, there is a same percentage. Okay, done? Now, this is the four bond theorems which you have to learn by heart. Everyone, four bond theorem you have to learn by heart because the question can be asked directly or indirectly or some sort of complicated question. So this is very complicated question. It can be asked. Okay, so you have to just understand the bond theorems. That is very very important for all of you. Now, based on this bond theorem, again we have a question here. Okay, now, here we have two bonds with different maturities. Okay. Bond X maturity in 5 year price is this, coupon rate is this. Bond Y maturity in 15-year price is this, coupon rate is this. Maya learned that the interest rate are expected to rise by 0.5%. Now, given the situation, how will the bond X and Y prices will behave with the interest rate change? Everyone. Again, very simple question. Understand the bond theorem and then you have to answer. Everyone, please answer this question. It's very simple now. Everyone. Ravi, please just focus on the question and then answer. Please just focus on the question and then answer. Ravi, Prabhu, Gursimran, Tanya, Kamal, Gopal, Prabhu, everyone. Just focus on the question and then you have to answer. Everyone. Okay, so there is only one answer B, and everyone else, Prabhu Singh C. Okay. Now, here, first of all, again we have to use two bond theorems. Now, bond first theorem says that there is an inverse relationship between the bond price and the market interest rate. As the market interest rate increase, bond price will decrease, vice versa. So we know that if the market interest rate is increasing, the bond price will be decreasing in both the scenario. So if you're saying that the prices of the bond will remain unchanged, that cannot be the answer. Okay. And now let's see what is actually asking in this question. Here we have different maturity. So if you have remember the theorem third says that longer the maturity, higher will be its price sensitivity. See, theorem third says that longer the term of the maturity, higher will be its price sensitivity. Okay. So we have two bonds. Bond Y's maturity is 15 years. So obviously bond Y will be more price sensitive than X. And both the bond price is decreasing. So bond Y price will decrease more than bond X. So if we talk about the correct answer, it is D. Bond Y will decrease in price more than bond X because it is the theorem third, which says that longer the maturity, higher will be its price sensitivity. Clear? So D is the correct answer. Now, if you have any doubt here, you can ask your doubt. Everyone, if you have any doubt in this case, please ask. Answer. Everyone, any doubt? If you have any doubt, kindly please ask. If you don't have any doubt, give me a thumbs up. Each and every one of you. Tanya, Prabhu, Harsh, Ravi, Gursimran, Gopal, Kamal. Clear? Everything is clear here. Any doubt? So that's why I'm saying that please just learn these four bond theorem in detail. So in this question, we have used theorem first and second. Then in this question, I have used theorem 1 and third. Okay, there can be question where you can just use theorem 1 and fourth. Or maybe the straight away questions can be asked. But this is because the numerical class, I have to give you the tricky questions. Okay, good everyone? Okay, next question. The price index of a specific commodity during June 2023 is reported to be 110, while the price index for the same commodity in June 2022 was 100. Using the indices, calculate the annual rate of inflation for the month of June. It's very easy. Annual rate of inflation you have to calculate. It's so easy, everyone. Please answer this question. Annual rate of inflation. It is what? We just have to calculate the annual rate of inflation, everyone. Please answer. We just have to calculate the annual rate of inflation. Please answer, everyone. Okay, so Tanya is saying B. Harsh is also saying B. Yes, so the correct answer is what? The correct answer is yes, B. because it is new, which is 110, minus old, which is 100, upon old, which is 100, into 100. It's so simple. It is 10%, which is the correct answer. Okay, 10% is the annual rate of inflation. Correct. Next question. An economy has a nominal GDP of $1,500 billion and a real GDP of $1,250 billion. After a period of economic growth, the nominal GDP increases to $1,800 billion, but the real GDP only rises to $1,500 billion. What is the GDP deflator in the second scenario? And what does it indicate about the inflation relative to the first scenario? Now, very easy question. Understand the question and then answer. Okay, everyone, understand the question and then you have to answer. Everyone, you guys, please answer this question. So, the correct answer is what? You have to just answer this question quickly, very easy, very simple. You just have to answer this question. So GDP deflator formula, first of all, what is GDP deflator? It is nominal GDP. GDP deflator formula is what? Nominal upon real into 100. Okay. So calculate. When we are talking about the nominal GDP, in the first scenario, it is 1500. 1500 upon 1250 into 100. Okay. Then in the second scenario, calculate nominal GDP 1800, real GDP 1500. Okay. So 1800 upon 1500 into 100. In both the scenario, if we talk about in both the scenario, if we calculate the GDP deflator by this formula, in both the scenario, it is coming 120. Okay, so GDP deflator in the second scenario is actually 120. It is coming in 120 in both the scenario. It means that the inflation has remained the same. So A is the correct answer. Yes, A is the correct answer in both the scenario. If you just calculate in both the scenario, it is coming like 120 in both the scenario. When it is coming 120, it means that it has remained unchanged. So the correct answer is A. Clear? The correct answer is A. Done? Yes. Now, next question. Let's move to the next question. An economy has the following component for the year. It is private consumption, $1,200 billion, private investment, $300 billion. It is consumption, $400 billion, export and import. What is the GDP for this economy? Very simple, very easy. GDP for this economy. Everyone, please answer this question. So easy. Please answer this question. Very easy. Yes. Let's see. 1200, very simple. It is 1200 plus 300 plus 400 plus x minus m. Okay, so it is yes, $1950 billion. So is the correct answer. Clear? Next question. An economy has the following data for the year. GDP at market price, it is given. Depreciation, net factor income from abroad, indirect tax, government subsidies. What is the national income for this economy? Okay, what is the national income for this economy? Everyone, please answer this question. Now, here we have to understand the question, what we have to calculate. Okay, what we have to calculate. First, you have to understand and then you have to answer. Everyone. First, you have to understand what you have to calculate and then you have to answer everyone. Okay, Ravi is saying C is the correct answer, and everyone else? Okay. So first of all, GDP at market price is given. GDP at market price is given. And we have to calculate national income. So national income is NNP at FC. I have told you, right? So national income is NNP at FC, that I have told you. So GDP at MP is given. We have to arrive at NNPFC. So what is the formula? How the conversion take place? If you all remember, first of all, we have to change gross to net. Gross to net minus depreciation, right? Domestic product into national product. So domestic product, if we have to change domestic product into national product, we have to add net factor income from abroad. Then market price to factor cost. We have to come market price to factor cost. Okay. So market price is the price at which a product is sold in the market, which is bigger, right? So market price to factor cost means minus the net indirect taxes. Now, minus net indirect taxes is indirect taxes minus subsidies. So GDP at market price is 2500 minus depreciation is 1200 plus NFIA is 100 minus net indirect taxes. So indirect taxes minus subsidy, which is what? Which is 100. Okay. So now see, plus 100 minus 100, 2500 minus 200. It is 2300. So the correct answer is C. C is the correct answer. Why D? Ravi, why D? C is the correct answer. As simple as that. C is the correct answer. Clear? Done? Any doubt here? If you have, please ask. If you don't have any doubt, give me a thumbs up. Any doubt here? If you have, please ask. And if you don't have any doubt, give me a thumbs up. Clear? Good. Now, next question. Reena invested 6 lakh in a mutual fund. After 2 years, the market value of her investment grew to 7 lakh 50,000. What is the absolute return on her investment? Very simple. Absolute return on her investment. It's very simple. So the correct answer is what? What is the absolute return on her investment? So the correct answer is what? Everyone. Very simple. It's so simple. Kamal, right? What is the absolute return on her investment? It is 7 lakh 50,000 minus 6 lakh means the original upon 6 lakhs means the original into 100. Obviously, it is 25%. So the correct answer is 25%. Clear? So this is the complete numericals for all of you, right? The complete numericals.